Hello again, everyone. It's Vince Forer from TradingWinds.com, and this is our update for January the 2nd, 2017. Happy New Year to everybody. Exciting times, a brand new year ahead of us. Let's take a quick look back, not only to last Friday, but what happened overall in 2016, and then we'll take a look ahead at what we can expect in 2017. Now, looking back on Friday, we closed off 2016 on a 3-day losing streak. Friday, the Dow was down 57 points, while the S&P was down 10 points, and the Nasdaq finished fairly unchanged. You can see the futures were down a little more, and the Russell was down 6 points. Now, the bonds were up slightly, up just 18 cents, while gold managed to lose about 6 points, and crude finished the year off fairly flat. Down about 5 cents at Friday's close. So overall, for the year, the Dow was up 13.4%, a very decent year. The S&P was up 9.5%, while the Nasdaq was up 7.5%. But what does this mean for 2017? What can we expect? Well, I think near term, we can expect a bit more of a pullback. If we look at the weekly charts here on the Dow, you can see we put in this bearish engulfing setup. So if we break below last week's low here, I think we can expect the start of a pullback. So this is what I think will happen overall for the markets. We'll start the year off with a bit more of a pullback, which would be healthy for this market, very healthy. We still have nice strong momentum to the upside, so a pullback would be welcome. Get us back in for another leg higher at much cheaper prices. The S&P 500 also putting in a fairly significant bearish engulfing pattern here last week. Nasdaq doing the same, and the Russell doing the same. So it's the same signal across the board on the weekly. Monthly still looks good overall. So I think we're going to see a near-term pullback here before a continuation of this move higher. Another leg higher. Beyond that, I think we see a much bigger correction. But for now, I think what we can expect is a bit of a pullback here before a continuation of this move higher. Now, there is one stock that looks like it could be in for something fairly big in the new year, and that's Amazon. We talked about this last week as it was setting up short, but didn't have much momentum to the downside. Friday, it sold off fairly hard here, down over 15 points on Friday on slightly more volume. This one certainly has been trading in a range for a while, but it certainly looks a lot more likely to break out to the downside than it is to the upside. If we look here across the different time frames, the weeklies also rolling over and also putting a bearish engulfing setup here. So a break below last week's low here, and we could be off and running to the downside. The monthly has strong momentum upwards, but is well within or has already started this pullback and is about halfway through of the range back to that 20-period moving average. So I think we can easily get back to these most recent highs here, which is in and around the 700 mark. 695 to 700 would be a great area for a pullback before a turnaround on that monthly chart. So that takes us easily down back towards these lows here. So I think that's very likely for Amazon. Only question is, does it hold these lows and bounce from here like we see on that monthly chart, or do we break below and head much lower? There are gaps below here. So if we look at this, there are certainly gaps to fill, and this could be headed to a much, much bigger move here. We could even potentially see these lows here near 480, but that is a stretch. At this point, we're looking for a move back to these lows, and then we will have to reassess at this around the 700 mark. If it doesn't hold that level, I think it easily closes this gap, comes down to about the 630 or so before heading towards these lows near 474. But yeah, it could be a wild ride for Amazon in 2017. That's just one of the stocks we're keeping a close eye on. In future videos, we'll go over many others. But that's about it for now. Enjoy the rest of your day, and we'll see you on our next update.